In calculating the yield to maturity on a bond, we need to remember that the yield to maturity is the market required rate of return that is implied by the current bond price. If we're using a financial calculator, we would need to enter the number of periods, the present value, the payment, and the future value. Remember the sign convention. So the payment and the future value need to have the same sign and the present value the opposite sign. We use 1 divided by y for the yield amount. If we're calculating, this example is using annual coupons. So remember, we generally have annual coupons, interest payments, or semi-annual coupons, interest payments. So this is a bond with a 10% annual coupon rate. We have 15 years until its final maturity, and it has a par value of 1,000. Its current price is $928.09. Will the yield be more or less than 10%? So we can think about this with some of just knowing the definitions that we know, that if the price is a discount rate, then our coupon rate is less than the current market rate. So we calculate this and we get a result of 11% as the current yield to market. Now, the thing to remember is that the yield to market can change because if we calculated this in 2 years when we had 13 years to maturity, the current price would have changed. If we have semi-annual coupons, so these are 2 times a year instead of once a year like in the original example. And this time, it also, instead of a discount bond, we have a premium bond. So we have a bond with a 10% coupon rate and semi-annual coupons. It has a face value or par value of 1,000 and 20 years until maturity. And it's currently selling for $1,197.93. So we want to know, is the yield to market more or less than 10%? Well, it's a premium bond, so we would expect the yield to market to be less. What is the semi-annual coupon payment and how many periods are there? So let's look at this through the 20 years with a semi-annual payment means that we have 40 payment periods because we double the payment periods. If we have a 10% coupon rate, that means we use half of that, or 5%. When we're calculating for what the yield to market is, then we get 4%. We need to take that amount times 2 to get the annual rate. So 4% is the semi-annual rate and 8% is the annual rate. When we are looking at bonds or even giving up stock, we have to think about what's the difference between debt and equity. So here's a list here of what the difference is between debt and equity. Mainly that debt doesn't include any voting rights or ownership interest, and that the interest payments that we do on bonds or on debt, notes payable, etc., is tax deductible. So there is a tax benefit for having debt. However, if we have too much debt, we might find ourselves in financial distress, and that can eventually lead to bankruptcy. Or we might not be able to take on more debt because we currently have too much and no bank is going to lend us more money. If we sell equity or stock, that gives voting rights, it gives up ownership interest, and we have the double taxation because dividends are not tax deductible for the corporation and they are taxed as income for each one of the owners. So dividends are not a liability until they're declared. They don't have to be paid unless there is a provision in place like preferred stock. that has guaranteed dividends, but dividends on common stock don't have to be declared and or paid. So stockholders don't have the same legal recourse to collect payments as creditors do. And a firm that is financed completely by equity can't go bankrupt. They don't owe any money except for to their common stockholders, and since you're not required to pay dividends, you wouldn't necessarily have to give your shareholders anything. When we create a bond, we create what is called a bond indenture. The bond indenture is a very large legal document, also called the deed of trust, that discloses all of the items within a bond provision. So it's the written agreement between the company and the bank detailing the terms of the bond issue or the debt issue. These can be several hundred pages long, and because they're legal documents, they're not the most enjoyable things to read. They do have a lot of very, very important information, though. So the basic terms of the bonds. What's the maturity on the bond? What is the coupon on the bond? Is it annual or semi-annual? What's the par value? What's the total amount of bonds being issued? So are we issuing 100 bonds or 200 bonds or 1,000 bonds? Are they secured versus unsecured? So do we have them secured? There's a guarantee provision in place. We've secured it with assets of some type, or is it unsecured, meaning if we default on them, we just default on the debt and there's nothing guaranteed that's securing them? Do we have a sinking fund provision, meaning that we have an account that where we start collecting the amount? So if we need to pay them off, we have the funds available. Is there a call provision? So the call is, that means that the company can buy the bond back early. So if there is a call provision, what kind of a call provision is it? And then any details of protective covenants. And protective covenants are the part of the loan agreement that limits actions the company might be able to take during the time of the bond provision. So, for example, they might have to limit the amount of dividends they pay out to guarantee that they have enough money available to pay these bonds. They might not be able to uh, sell any major assets, especially if they're secured bonds. There's a wide variety of things that can be part of that protective covenant. What kind of bonds do we have? Well, there are all kinds of different bonds, and this is just a very short example of the types of bonds that we can have. So we can have a registered or a bearer bond. A registered bond has a registered owner for each bond. Bearer bonds don't have registered owners, and the person who gets to cash in the bearer bond is the one who is physically has access to it at any given time. Bearer bonds used to be extremely popular, but they are less and less popular throughout the years because they are very susceptible to theft. And they're susceptible to theft because there's no owner registered as part of the bond, and whoever is physically touching the bond owns the bond. If you could get bearer bonds from the current owner, then you became the new owner for the bearer bonds. We can also have secured bonds. So We can secure them with financial securities. We can secure them with real property. Then they're called mortgage bonds. They can just be regular bonds, which are called debentures, which are unsecured, or they can be notes, which means they have a maturity less than 10 years. And then we have senior versus junior bonds and types of subordinated bonds. So seniority tells us if there's a preference for paying off over other lenders. And this means if we're senior or subordinated, this means if our company goes bankrupt, that senior bonds have priority for payment over junior bonds, and subordinated bonds have will only be paid after any specified creditors have been paid. So that it creates the seniority for when debt is paid off in the event of bankruptcy. So bond characteristics and required returns. So one, the coupon rate. The coupon rate is the risk characteristic of bond when it's issued. It is usually the yield at issue. It's usually the yield at which we say the annual or semi-annual coupons are going to be paid. Which bonds have higher coupon rates? If everything else is equal, well, secured debt tends to have a higher coupon rate than unsecured debt, such as a debenture. Subordinated debenture versus a senior debt. So remember, the senior debt is going to have higher priority in payment. And some of this is because of the risk involved in them. So if we're taking on more risk, we're going to want a higher rate of return or coupon. So a bond with a sinking fund versus one without. So a bond with a sinking fund is going to have less risk to it than one that doesn't require a sinking fund. Remember, the sinking fund is kind of a savings account that says that we're going to have the cash available to pay the bond at its due date. A callable bond versus a non-callable bond. So if there's a provision within the bond that the company can buy it back early, remember, if we have a callable bond and the company buys it back early, that means that they don't have to make interest payments anymore. So if we were counting on that interest payment as part of our return, then we might not be very inclined to take callable bonds that can be called back early. Bond ratings. So there are two basic bond rating companies, Moody's and Standard & Poor's. They're the two leading bond rating firms. Bonds are rated based on the capacity to pay, if they have a history of defaults, the company's general how well they're doing. The highest rate you can get is a triple A bond. So the Moody's is a triple A with a capital A and small a's, and then the Standard & Poor is just a triple A. Medium grade bonds would be A and B bonds, and then we get into lower grade bonds. Lower grade bonds are also called speculative bonds and can sometimes be called junk bonds. So junk bonds are low grade bonds, and they usually mean that that company has defaulted at some point on a bond. We don't really think that they have a really good capacity to pay. They might have had cash flows issues in the past. They might have defaulted in the past. And they might not pay any interest. So there are certain kinds of bonds that don't pay any interest. A bond's credit rating changes as the company's financial strength either improves or gets worse. And so bond ratings can change from year to year.